Welcome to Video 4, Introduction to the Accounting Process. Let's take a look at our roadmap, and we've made it to the Accounting Crash Course. This is the first video of the Accounting Crash Course, and I'm just going to overview the accounting process in this video, and then we'll dive into the nuts and bolts of how do accountants convert economic activities into the balance sheet and income statement that we see every year. So here's just a diagram. I took this from a textbook and modified it slightly. At the bottom of the diagram, here you have a little cartoon person saying this is accounting. And so I've tried to kind of manipulate this diagram a bit. At the bottom, let's start there with the economic activities. Firms engage in lots of different economic activities. They take investments from investors. They invest in assets like inventory and PP&E. They produce and sell inventory. They pay employees, and they do all sorts of other economic activities. And sometimes we'll refer to these as transactions. Well, when these occur, accountants use accounting rules and sometimes use their own judgments to convert these economic activities into journal entries. And journal entries are how we track economic activities. We collect journal entries in T accounts. For each account on the balance sheet and income statement, that account has a T account, which is tracking the journal entries, and the journal entries are made to reflect the economic transactions. And so when you see the balance sheet and income statement at the top, that is just a reflection of the T accounts, which contains the journal entries, which are tracking the economic activities of the firm. And so that's the accounting cycle. Here's a list, okay, the accounting process that we're going to go through over the course of the next few videos. The first thing you need to do as an accountant, so you're not going to be an accountant, but I'm going to teach you how accountants do their job. When you observe an economic activity, you need to understand and analyze the transaction that happened. If it requires a journal entry, you need to record general journal entries as those transactions occur, and you need to post your journal entries into T accounts. At the end of a period, sometimes we need to make adjusting journal entries just to finalize the end of a period, and we'll also post those to T accounts. And once we're done with steps 1 through 3, we can report our income statement for the period of time that we're reporting. After we report our income statement, we'll record something called the closing journal entry, which transfers all the income and expenses from the income statement into our net worth on the balance sheet. So that's the entry that transfers the income statement earnings into retained earnings on the balance sheet. It's called the closing entry. And finally, step 6, once we've recorded that closing entry, we can report our balance sheet. So this is the accounting process that accountants go through every year, and we're going to go through it in the next few videos. So in the next video, this has been the introduction to the accounting process. The first step we're going to go through is the basics of transaction analysis. So that'll be our next video, the basics of transaction analysis.